a few different forms of equity, or a few different ways that you can raise equity for your company. The initial method that most business owners will consider will be what we call angel capital. Angel capital typically comes from private investors that are invested into angel funds, and they place what we call seed capital into a business to help it grow initially. It's that initial funding that that business needs to get started. It's working capital, to buy its equipment, to do those types of things. So angel capital is that initial seed capital to bridge the initial gap when a company starts. So as that company starts to grow and it needs more capital, then maybe if you're in the right type of business or the right company, you may consider going to venture capital. Venture capital is a little bit more advanced than angel capital. They normally are able to supply bigger amounts of money. So angel investors historically have provided about $1 million or less. So if you need $100,000 or a few $100,000 and you want to raise equity capital, you would typically do that amongst angels. If you needed several $1 million, you think back to Google. You know, Google right now, I looked at their stock price today when I was heading out of the office. They're trading probably slightly over $500 a share. But there was one point in time where Google wasn't a publicly traded company. It was a private company. And the way they were able to grow the company and make the kind of investments that they made into their infrastructure and into software and into personnel was through venture capital. One of the things you may want to keep in mind with venture capital is venture capitalists, or sometimes we call them vulture capitalists, because you do have to be careful of these guys. They do want to take a position in your company. They want to be a part of the management. They want to be on the board. And they want to protect their investment. And there's good reason for that, because they're putting money into a company when it's most risky. And they get a huge payout when that company goes public. So you can imagine how some of the venture capitalists feel right now, the guys that backed Google when they first came into the marketplace. Another way that most companies, and how many small business owners do we actually have in the room? Or how many looking to be a small business owner? Okay. Most ways that you fund your equity capital, and you can raise your hand if you did it like this, you self-fund it. You self-fund your equity capital. That means you're investing that initial capital yourself into your company, and we're going to talk about a few ways that you actually can do that if you're looking to start a business. But the thing to keep in mind, because I also get this question, well, I want to start a dress shop. Can I raise venture capital? Probably not. That type of a company just doesn't have that kind of a return on it. Most companies that venture capitalists are going to look for will be technology-based companies, or companies that are based in medical care or medical devices, or even companies that are based in what we call revolutionary consumer goods. Somebody's coming out with that new widget that's going to change the world. That's what venture capitalists are looking for. Companies like Google. Someone seen several years ago that Google was going to revolutionize the way that we search for information, and they made an investment into that company. So you keep that in mind as well. I mean, the same thing with angel investors. They're normally looking for a company that's got that potential to go public at some point in the future. So once again, we get back to small business. What about you? What about in your position? How could you potentially go out and raise that equity capital? What I like to suggest to folks that have really small companies, a good way to do it is to look right in your own circle of friends. Your own family, your own friends, the people that know you, the people that have come up with you over time, the people that trust you, they trust your decision making. Those are some of the places you want to look initially if you need equity capital to get off the ground. That's what we did with Wharton Gladden. The initial investors in the company were family members. There were people that wanted within our family that trusted my ability to manage, trusted my ability to lead, and they invested in me. They didn't really invest in the company. They invested in me. So that's what you want to consider as well if you're looking to bring equity capital into your business. Look amongst your own circle of family and friends. You may be surprised at some of the people that are in your circle that's willing to make that investment into you. So once a company does mature, they brought that initial capital into the business, and they've matured, but they still are starving for capital. Because as companies grow, they're like kids. Now I know my daughter, she's 4 years old. We were sitting at the table together last night, and she was sitting there eating spaghetti and eating all the bread and salad. She had about 3 bowls of salad. And I was sitting there looking at her. The bigger she's gotten, the more hungry she gets. So that's the way a company is. The bigger it gets, the more hungrier it gets, the more capital it needs in order to stay going and to stay fit. So what some companies consider are IPOs, initial public offerings. You've probably heard of those. I mean, some companies that went public, maybe you've had the opportunity to buy into some of those companies when they went public. I know a lot of people were clamoring around trying to get Google shares before they reached the open market. But a lot of companies don't reach that point where they actually can go public. Most companies here in America are privately held companies. Most of the companies here in our country remain private. So how do those companies raise money once they get so large that they need to go to the market and start bringing in more capital? Well, it's something that we call private placements. And you can normally do a private placement through an investment banker or through some type of an attorney. And essentially what they do is they raise money from purely what we call our accredited investors. So they don't go to the public market like an initial public offering, but they do a private placement where they just reach out to accredited investors. And the way that you categorize an accredited investor, they have to earn $200,000 in the previous 2 years, and they have to have a net worth of $1 million. So the government says if you raise money amongst those types of people, you don't need to register yourself with the Securities and Exchange Commission because those people have good assets, they make good income. The government assumes that they're going to be in a position to make good decisions about their investments. So that's another way that you can raise equity capital is through private placements. So those are a few methods to keep in mind when you're thinking about how to take on initial or additional equity capital if you either have started a business or looking to get into a